Welcome to This Explainer. Today, we're diving into something that is quite literally one of the biggest, most expensive misunderstandings in the entire transportation world. We are going to demystify the massive cost and liability differences in trucking insurance. It's a huge blind spot, and honestly, most drivers completely miss it until it's way, way too late.
So let's just jump right into this crazy paradox. Picture two truck drivers. They're driving the exact same type of truck, hauling the exact same freight, cruising down the exact same stretch of highway. But here's the kicker. One of these drivers is paying almost nothing out of pocket for their insurance, while the other is shelling out $25,000 or even more every single year. I mean, why such a massive gap, right? Well, it all boils down to how they're set up to operate. One driver is leased onto a carrier, and the other is running their own independent authority. Here's our roadmap for This Explainer. We'll start with the trucking insurance divide, move into the hidden coverage gaps for leased-on drivers, explore the true cost of independence, look at some real-world claim disasters, and wrap up with the critical questions you need to ask before you drive. All right, Section 1. The trucking insurance divide, defining the paths. Before we get into the dollars and cents, we really need to nail down what these paths actually mean in practice. When you're a leased-on driver, you're operating under another company's Department of Transportation, their DOT number, and their motor carrier or MC authority. Because that carrier is handling the dispatching and the freight contracts, you, as the leased driver, generally fall under their primary liability insurance. Now, on the flip side, an independent owner-operator is running under their own DOT and MC numbers. And what does that mean? It means they have to go out and buy every single one of their own trucking insurance policies. That right there is the fundamental reason why independent authority comes with such a massive price tag.
Moving right along to Section 2, Leased-On, hidden coverage gaps. The illusion of full coverage.
You know, the absolute biggest mistake lease drivers make is just assuming the carrier's policy covers everything under the sun. It doesn't. Yes, when you're leased on, the carrier usually provides primary liability insurance that covers bodily injury and property damage. But, and this is a huge, flashing red lights kind of but, that coverage has very strict limits. It generally only applies while you're actively hauling under dispatch. So cheaper definitely doesn't automatically mean fully protected. If you aren't paying close attention, you can fall into some pretty terrifying coverage gaps. For instance, think about what happens when you physically drop your trailer at a facility. Let's say you've made your delivery, unhooked the trailer, and now you're just driving the cab back home. Well, you're no longer under dispatch, and you don't have a trailer attached. In that exact scenario, your carrier's primary liability drops right off. It's gone. That makes Bobtail insurance an absolute non-negotiable necessity for leased-on drivers to plug that specific hole. And that actually brings us to another super vital concept, non-trucking liability, or NTL. Your carrier's policy might literally provide zero coverage when you're using the truck for personal use or when you're off dispatch. NTL is specifically designed to step in and cover your truck during those exact personal use moments. Let's ground this in a real-world scenario so you can see exactly how dangerous this coverage gap is. Imagine you just finished a load. You are officially off dispatch, right? You decide to take the truck down the road to grab a bite at a local restaurant. And on the way, boom, you cause an accident. So what happens next? Well, here is the really scary part. The carrier's insurance company is gonna step in, take one look at the logs, and say, nope, sorry, this driver was not under dispatch. If you didn't buy non-trucking liability coverage beforehand, you are now facing direct personal liability exposure. Think about that. Without NTL, you could face total financial ruin for an accident that happens on a simple grocery run, all because of a misunderstood policy limit. It happens all the time. Okay, on to Section 3, the true cost of independence, the heavy crown. The freedom of having your own authority is super appealing, for sure. You get more control, you build direct broker relationships, but operating independently means you are entirely on your own hook for primary liability, your own cargo insurance, and physical damage. And for a brand new independent authority, that annual cost is absolutely brutal. We're talking anywhere from $20,000 to over $40,000 a year. That is literally like buying a brand new car every single year just for the privilege of driving your own truck. You might be sitting there wondering, why on earth is the startup shock that severe? Well, insurance companies evaluate risk purely on proven operational history. When you spin up a brand new independent authority, underwriters look at you and they see zero business history, zero loss history, and absolutely no proven safety systems. Plus, statistically speaking, new authorities just have higher claim rates. Because you lack that proven track record, they treat you as extremely high risk. And that drives those initial premiums right through the roof. When we stack up the monthly financial realities side by side, it is literally night and day. Leased-on drivers might pay for occupational accident and bobtail coverage, which keeps their out-of-pocket relatively low. But independent operators, they are writing massive checks for liability, cargo, physical damage, filings, and permits. That means they are often bleeding thousands of dollars every single month before their truck even rolls a single mile.
Let's look at Section 4, Real-World Claim Disasters, when things go wrong.
When you're flying solo as an independent, a claim isn't just a headache, it's an existential threat to your business. Consider this staggering number for a second. $58,000. In one real-world case we reviewed, an independent owner-operator had a severe injury accident. Come renewal time, their premium didn't just tick up a little bit. It skyrocketed from $24,000 to $58,000 a year. One major accident under your own authority can trigger premium spikes so extreme they completely destabilize your entire operation.
And hey, it's not just about accidents. Under your own authority, you absolutely must be accurate when disclosing your freight type and operating radius. Playing games with this can trigger massive consequences. Let's say an owner-operator tells their insurance company they only haul general freight, trying to keep those premiums down. But in reality, they're regularly hauling highly targeted, high-risk stuff, like expensive electronics. Well, if a cargo theft happens and those undeclared electronics are stolen, you better believe the insurance company is gonna investigate. And when they find out the cargo is high risk and undeclared, they will outright dispute and deny the claim. Just like that, the independent operator is left holding the bag for a massive cargo loss. That kind of hit can instantly bankrupt a small trucking company. Accuracy is non-negotiable. Even protecting yourself from injury looks totally different depending on your path. Leased-on drivers often get to use streamlined occupational accident insurance. But independent operations, depending on the state they operate in, they might be required to secure heavy, highly complex, full workers' compensation policies. This insurance divide really does dictate every single level of how you run your business. All right, finally, Section 5, Questions Before You Drive, Actionable Takeaways.
We've thrown a lot of heavy risks your way, so let's boil this down to the exact questions you have to ask. If you're leaning toward leasing on, never, ever assume the carrier covers everything. Ask them point blank, what exact insurance do you provide? What are my deductibles? Who pays if the trailer is damaged? In our source material, there was a driver who just assumed trailer damage was covered. They had a backing accident, and suddenly thousands of dollars were being deducted directly from their paychecks simply because they misunderstood the lease agreement. You've got to read the contract. On the flip side, if you're chasing the freedom of going independent, you have to do a brutal, honest assessment of your financial padding. Ask yourself, can I actually afford the $20,000 to $40,000 startup insurance costs without sweating? Do I really understand all the filings and compliance required? And maybe most importantly, if I have a catastrophic claim, can my business actually survive a sudden premium spike to 55 grand? The freedom increases, yes, but your financial responsibility increases exponentially too.
And that brings us to the ultimate takeaway here. Neither path, leasing on or independent authority, is automatically the right or better choice. But misunderstanding your financial exposure, that is a guaranteed path to failure. So based on your true risk tolerance and the actual financial padding of your business, which operational path can you truly afford to take when disaster inevitably strikes? Thanks so much for joining me for this explainer. Keep asking the tough questions and stay safe out there on the road.